Hello and welcome to BQ Prime. I'm Hiral Dadia. One stock that has been in focus is CSB Bank, and this is on the back of the business update that has come in for the third quarter. The bank has witnessed a strong credit growth. To discuss the same and give us more modalities around it, joining us on the show is Mr. Pralay Mondal, who's the MD and CEO at CSB Bank, joining in. Welcome to the show, Mr. Mondal.
Thank you, Hiral, and Happy New Year to you and your viewers.
Wish you the same as well. Mr. Mondal, my first question coming to you is firstly, what has led to this kind of strength with regards to the credit growth?
So if you look at Hiral, last year, our FY growth was around 9%. From there on, these last three quarters, Q1, Q2, Q3, we had consecutively growth of 16, 24, and 26%. So it's sustaining over a period of time based on various activities we are doing in the bank. We are putting a lot of investments behind the future growth strategy, whether it is retail, SME, the technology kind of investments we are making. Those things will come in the next 18 to 24 months. But primarily, this credit growth has happened on the back of sweating the system on the gold loan side. And we understand that business well, and we were leveraging our existing network, branches, and franchise to build that business. In parallel, retail has started also contributing, wholesale and SME is also starting to contribute. So overall, it's a good story, and we hope we can see this as well.
Right. So as you mentioned, the entire growth story right now is pretty much aligned with the gold loan portfolio, right? The gold advances have grown around 9% on a sequential basis, and the mix now stands at around 47% versus a 39% that we saw earlier. So between the gold and the non-gold portfolio, where do we see this mix actually settling in?
So the way we look at it is gold as a standalone basis will continue to grow. And as we enlarge the base will get enlarged based on the retail, SME, and wholesale franchise. And we don't want to rush into a retail kind of a business because retail, as you know, is a long-term story. You have to build a franchise, customers, new acquisition, partnerships, technology, digital, so many other things. So we are significantly investing into that. So I can tell you that if you look at a slightly longer term story and say exit 2030, where we'll be, retail will be our largest portfolio. And we expect retail to be around 30% of our portfolio, followed by gold. So clearly, the longer term highway growth will come from retail. SME will continue to grow quarter on quarter and year on year for the next 7 years. And wholesale will be, as a mix, will remain where it is right now, around 25%. So that's what the story is. Yeah.
So you're saying that retail portfolio will be 30% of the loan portfolio by 2030, right?
Yeah.
And with regards to SME, what's the kind of contribution that we see from that segment?
So it's a longer term story, but let me just give you a slightly high road on this one. That by exit 2030, the plan is 30% retail, around 20% gold, and rest between retail and wholesale and SME, we'll have a kind of a 50-50 between the two. So which typically SME will be around 20 to 22% and wholesale will be the rest. So that's broadly what we plan to. And hence retail will be our primary driver. But to ensure that happens, you need to get the gold loan going, because gold loan, the risk weights are very low. NPA is almost nil. The operating cost is high, but operating cost is already baked into the bank. So if you sort the system, you get higher productivity. And hence, to retain our cost to income, which will remain little elevated for a while, to retain that where investors expect it to be, need to have a revenue coming out of the gold loan. So we are very strategically placed here, saying that gold loan will drive the investments into the bank for the future retail and SME and wholesale of the business. And hence gold loan is a very, very important business for us, and we'll continue to grow that business faster.
Right. So would it be right to say that gold loan portfolio will be the cash cow?
Yeah, absolutely. I didn't want to use that word, but that's what it is. You got it right. Yes.
Right. So moving from there on, overall, from your deposit and CASA perspective, there has been some bit of moderation that has started to come in, but that's across, the smaller banks as well. Now, how do you see the deposit and the CASA from here on, taking into consideration that there is going to be probably a stiff competition in terms of the deposit rates from here on, taking the kind of demand we would see in the last quarter at least?
No, absolutely right. And this is and banking business is about liability franchise. We're building a granular, good liability franchise. If you get that right, you get the customers, rest of the businesses happens automatically, right? So we are very focused as a bank to build a very strong liability franchise with granular focus. But at the same time, we must understand that we are in a very specific period where the interest rates are high, and suddenly things have changed a lot, and liquidity in the system dried up in the last quarter. It's starting to come back with government spending and all that, but it will remain a little bit of a pressure, as you rightly said. So, and everybody is going for liability, and hence competition is high. Given that perspective, we have very clearly said that CASA is a high road. It will take time to build, and we will build that. And CASA only builds when there is a reason to build that, which is you have cross-sell, you have products, EMIs, and all of that stuff. So we are working on that. Current account is something which we'll start focusing from next quarter in a big way. We are building a transaction banking business. Along with that, the current account will also start building up. SME, along with current accounts, is also a very big focus for us. But funding of the growth which we are planning, and which will be typically 30, 40, 50% faster than the system in the next 3 years at least, we need the right funding. And for that, you will continue to see our deposit growth faster than the CASA growth at this point of time. And hence our CASA ratio will not grow at this stage. And come 2025 onwards, we'll start seeing the CASA ratio starting to grow. Because if you even look at it mathematically, even if your CASA growth hypothetically grows faster than the deposit growth, but the overall growth of the bank is 2 times, 3 times faster than last year, then automatically CASA ratio comes down. That's pure maths, right? So from that perspective, I'm not so focusing on the CASA ratio right now. Eventually, we will when we have the full service franchise, which will be FY25 onwards.
Right. So overall, from a CASA perspective, we've seen a 31.4% currently, whereas previous quarters, it's in that range of around 34 to 35%. So would it be right to say that we will see it moderating in that 30 to 31% band, or will it be sub 30% going ahead as well, taking into consideration that's not going to be our focus area right now?
See, I can't really go to that decimal point, but all I can tell you is that CASA ratio is just a ratio. What is more important is, I mean, it's very easy to have a higher CASA ratio if I did grow only by 10% as a franchise. We will focus on our franchise growth. Within that, whatever granular CASA growth will continue to happen the way it was happening in past. And to fund that growth, if you have to have higher deposits, we'll take it. But you're right. I think broadly you got it there. Around 30 to 32% is somewhere we want to retain the CASA ratio if we continue to grow at a similar kind of a pace where we are growing right now.
Right. Apart from that, overall, if you go to see, with interest, with regards to net interest margins as well, it is widely expected to peak now because the liquidity situation is also tighter for most banks, right? And if you see the liquidity coverage ratios across is closer to 100% for most of the banks, and it can't go below the 100% mark from here on. So with this said and done, is it going to be right to actually run after deposits, which will lead to squeezing margins?
It's a very good point you're making. Yes, LCR, as you rightly said, liquidity ratio is extremely important, and we monitor that very carefully. We are somewhere in the range of 120. But as you know, now balance sheet, it can go this way, that way very fast. So we are keeping a close watch on that. That's number one. Number two is, does this create any kind of a challenge in terms of getting cost of funds going up? Answer is yes, because already you have seen that the deposit pricing has got elevated. Because to be competitive and in that ecosystem where we are, deposits rates are very high, and it's getting passed on to the customers. But typically what happens is there's a back book and front book, right? And this back book gradually moves towards front book over a period of time as renewals happens. And hence in the Q3 of next year, you will see cost of funds going up for all banks, including us. And already a lot of yields which had to be passed on had got passed on, and hence there will be a little bit of an NIM compression that will happen for the entire ecosystem, and same for us. So we are quite happy keeping a NIM around 5%, and if you get the growth right, because ultimately profit is a multiplier of growth, right? So if you get the growth right, if you get the NIM somewhere around 5%, we are quite happy with that.
Right. Okay. And with this overall, if you see in terms of the year as a whole as well. We've spoken about net interest margins, we've spoken about how the deposits could pan out, but clearly from here on, if you go to see, branch addition is something that you're looking at to increase your retail portfolio as well. A lot of investments going towards the SME and the retail portfolio. So are we expecting the OPEX to also increase from a banking perspective?
Absolutely, OPEX will increase. That I keep talking to investors, because we are in an investment phase. But when I say OPEX, one part is cost and one part is investment, and investments always have a payback period. So from that perspective, we see that our cost to income, which is somewhere between 55 to 60, and it will remain at that level. By 2030, I have a plan to bring it down somewhere around 45%, because you have a payback for every technology and other investments we are making. Yes, OPEX will go up, and hence we have to ensure our non-interest income to total income has to go up, and that's where I'm focused on. And overall income also has to go up, not only by the because of the balance sheet growth, but also because of the cross sell and some of the other initiatives which we have created, which will take our fee income also up. And we are in a situation where treasury income, some of this PSLC incomes, etc., is muted at the point of time for the system. So we have to sweat the system a lot harder to get the other income, but we are focused on that.
Right. And very lastly, overall, if you see in terms of the second half of FY23, the anticipation is that the PSLC income that is likely to come in, and that's something which will actually boost other income and earnings for FY23. Anything that you would want to add on that front?
What has happened, something very strange which has happened this year on the PSL's income, because, and my theory is like this, that suddenly on a lower base, the credit growth has picked up. And hence, as you know, that PSL target is based on our NBC, which is last year's base and this year's business, right? Numerator is the this year's business and NBC is last year's base. And hence, a lot of banks will achieve PSL objective without sweating for it too much this year. And hence, you will see the PSLC premiums are reasonably low this year. So I'm not betting so much on the PSLC income. We did book some this quarter, but I'm not betting on that. But this income will be quite good next year, because next year to this year's NBC, which is this year's base, will become the NBC for next year. And next year, credit growth at best will be at the same level, even if it does not taper down. So you will see a lot of demand for PSLC next year. So I'm not baking in too much of PSLC income this year, but I expect PSLC income to get elevated. And for us, PSL is a very good business, because we do a lot of gold loans and other agri, rural businesses, etc. So I'm keeping it for next year. This year, I'm not baking too much of PSL's income.
Right. And my last question coming to you, overall, what according to you for the banking space will be the key monitorables as well that, one should be watching out for?
See, I think if the country has to grow at a GDP, which everybody expects us to grow, and have that grand vision of becoming among the top 2 or 3 economies in the world over the next decades, banking has to take that share of its responsibility, right? Because CapEx growth will start coming back, infrastructure, there's a lot of investments that will go in there. And hence banking is going to, and India broadly, credit markets are based on banking, unlike some of the other developed countries, etc. Debt markets is still not picked up that much. So banks will see elevated credit growth, in my view, has to be there. And the good news is, in the entire banking system, we are at really a sweet spot. Growth is coming back, NPA is decade low, investments, CapEx, CRR is not such a big issue anymore. So given all this, I think it's a sweet spot for banking at this point of time. But always remember, wrong decisions happen at the best times, okay? And we have cleaned up everything. We must ensure we remain, and including the corporates, everybody remains careful and continue to grow with the right kind of risk parameters. We are too small as a bank to comment on that. Frankly, I'm talking more from a system perspective.
Right.
For us, we are very, very internally focused and say that let's get our execution right and let's get it growing.
Absolutely. The change in strategy is absolutely working as well that, CSB has embarked on. Thank you, Mr. Mondal, so much for joining us on the show. Pleasure speaking to you and to have a candid chat. Thank you. Stay safe and speak to you soon again.
Thank you, Hiral, and have a good day ahead.
You.
Thank you.
You too.